The formula started with a phone call nobody was supposed to overhear. A senior reserve manager at a mid-sized European central bank, speaking anonymously to a financial journalist, said something that should have made headlines everywhere but barely got a mention. He said his institution wasn't buying gold because they expected inflation or a recession or even a stock market correction. He said they were buying gold because they no longer trusted the system that priced everything else. Read that again. Not a hedge against a bad quarter, not a defensive play before an election. A quiet, permanent vote of no confidence in the entire architecture of paper money as we know it. And once you understand why a central banker would say something like that, you start to understand why gold at $10,000 an ounce isn't some fringe fantasy anymore. It's a number that serious people, people who move billions, are now modeling as a base case. Not a moonshot, a base case. So let's actually walk through the formula, because there is one. It's not magic, it's not hype, it's math, behavior, and history colliding at the same moment. And once you see it, you can't unsee it. Start with the simplest piece, supply. Gold is not oil. You cannot simply drill more of it when demand spikes. Global mine production has been essentially flat for over a decade. The easy deposits, the shallow, high-grade ore bodies that made 20th century mining profitable, are gone. What's left requires digging deeper, processing lower-grade rock, and spending more capital per ounce than at almost any point in modern mining history. Some of the largest gold mining companies on Earth have openly told their shareholders that production is going to plateau and in some cases decline over the coming years, no matter how high the price goes. Think about that for a second. In a normal market, a higher price incentivizes more supply. Gold is one of the rare assets where that relationship is breaking down because the deposits simply are not there in the volume they used to be. That's not speculation, that's geology. Now overlay demand, and this is where it gets interesting because demand isn't coming from where you'd expect. It's not retail investors piling into gold ETFs after watching a video like this one. It's central banks, sovereign institutions. The people who print the money in the first place are the ones quietly stockpiling the one asset they can't print. Think about the strangeness of that. The very institutions responsible for issuing currency are hedging against their own currency. When the People's Bank of China buys gold, when the Reserve Bank of India buys gold, when Poland, Turkey, Kazakhstan, Singapore, and a rotating cast of emerging and even developed economies all quietly add tons to their vaults year after year, they are sending a signal. And the signal is this: we are no longer comfortable holding the paper promises of another country's government as the backbone of our reserves. For nearly 80 years, the dollar was the unquestioned foundation of the global financial system. Every oil trade, every major international transaction ran through it. That gave the United States an extraordinary privilege, the ability to run deficits, print money, and export inflation to the rest of the world, because everyone else needed dollars to function. But privileges like that only last as long as trust does, and trust is exactly what's eroding. You've probably heard whispers about BRICS nations exploring alternative settlement systems. You've probably seen headlines about countries trading oil in currencies other than the dollar. Individually, these stories seem like noise. Collectively, they are the sound of a tectonic plate shifting. Reserve managers who used to hold 90% of their foreign reserves in dollars are now diversifying into gold at a pace not seen in half a century. The World Gold Council has documented central banks adding well over 1,000 tons a year for multiple consecutive years now, levels that dwarf anything seen in the prior 2 decades combined. And crucially, surveys of these very institutions show the overwhelming majority expect their gold holdings to keep rising, while a shrinking number expect the dollar share of reserves to hold steady. This is the quiet part becoming loud. Now let's talk about the historical parallels, because this is where the formula really clicks into place, and where the parallels are honestly a little unsettling if you know your history. Go back to 1971. Richard Nixon stands in front of television cameras on a Sunday night and announces, almost as an afterthought buried among other economic measures, that the United States will no longer allow foreign governments to exchange their dollars for gold. The Bretton Woods system, the post-war arrangement that had anchored the entire global economy to gold through the dollar, was over, overnight. No warning to allies, no congressional debate broadcast to the public, just a decision made under pressure because the United States literally did not have enough gold in Fort Knox to back the dollars other countries were demanding. What happened next? Gold, which had been artificially pegged for decades, was suddenly free to find its real price. Within a decade, it rose more than 20-fold. 20-fold. People who held physical gold going into that transition preserved and multiplied their wealth. People who sat in cash watched their purchasing power evaporate under double-digit inflation. Now go to 1980. Silver, not gold, tells this story best, but the lesson applies to both metals. Two brothers from Texas, oil money behind them, decided the paper futures market for silver was a rigged game stacked against physical holders, and they set out to corner it by buying real physical metal. Silver rocketed from single digits to nearly $50 an ounce in a matter of months. It was a bubble, yes, and it popped violently when the exchanges changed the rules mid-game, but strip away the manipulation angle for a second and look at the underlying truth it revealed. When enough capital decides physical metal is scarce and paper claims on that metal vastly exceed the actual metal sitting in vaults, the system becomes fragile in ways most people never see until it's too late. That fragility hasn't gone away. If anything, it's worse now. Today, for every ounce of physical gold that actually exists and is deliverable through major exchanges, there are estimated to be dozens of paper claims on that same ounce. Futures contracts, unallocated accounts, synthetic exposure through funds that don't actually hold bullion one-to-one. This is sometimes called the paper-to-physical ratio, and depending on which market data you examine, on any given delivery day, the exchanges could be exposed if even a modest fraction of paper holders demanded actual metal instead of a cash settlement. Most of the time, this works fine, because most people never ask for delivery. But history has shown again and again that confidence in paper claims can evaporate fast, and when it does, the scramble for physical metal becomes its own accelerant. Then there's 2008. The global financial crisis wasn't really about subprime mortgages, not at its core. It was about trust. Trust that banks marked their assets honestly. Trust that counterparties could pay what they owed. Trust that the system itself was sound. When that trust cracked, gold did something remarkable. It initially dropped alongside everything else as investors scrambled for cash to cover margin calls. And then, once the dust settled and central banks around the world responded with unprecedented money printing, gold began a multi-year climb that took it to what were then record highs. The lesson from 2008 isn't that gold is immune to short-term panic. It's that gold is the asset people run to once they understand what the money printing response to a crisis actually means for the value of their savings. And now think about 2011, another year gold hit a then record high, driven by a U.S. debt ceiling standoff and the first ever downgrade of the United States credit rating by a major ratings agency. Standard & Poor's stripped the U.S. of its perfect credit rating, and gold surged as investors questioned, for the first time in living memory, whether U.S. debt was truly the risk-free asset it had always been treated as. That question has never really gone away. It's only gotten louder as the national debt has climbed into territory that would have seemed unthinkable a generation ago. So here's the formula, laid out plainly. Take flat to declining physical supply. Add central banks buying at a record sustained pace because they no longer trust the dollar as the sole reserve foundation. Layer in a paper market that is many multiples larger than the physical gold that actually exists to back it. Combine that with a historical pattern where every major loss of confidence in the monetary system, 1971, 1980, 2008, 2011, sent gold to a new plateau it never fully retreated from. And now add the newest ingredient. Open, serious discussion among BRICS nations and other emerging economies about settlement systems and reserve structures that don't depend on the dollar at all. When you stack all of that together, $10,000 an ounce stops looking like a headline designed to grab clicks. It starts looking like simple extrapolation. Quick aside, because I know some of you watching this are specifically thinking about your retirement accounts and not just the macro picture. If you've got $100,000 or more sitting in an IRA or an old 401k, I put together a completely free guide that breaks down the saving strategies thousands of American retirees are quietly using right now to protect what they've built. It walks through exactly what's happening and what steps people are taking in response. It's linked in the description below this video. Costs you nothing to look at it. Okay, back to the analysis, because there's more you need to understand about how this actually plays out. Let's talk about the mechanics of the exchanges themselves for a moment, because this is the part almost nobody explains clearly. COMEX, the primary U.S. exchange where gold and silver futures trade, operates on a fractional system. The vast majority of contracts are settled in cash, not metal, which is exactly why the paper market can be so much larger than the physical market without collapsing on a normal day. But every so often, something called an increase in delivery demand happens. Funds or sovereign buyers who actually want the metal moved into their possession, rather than accepting a cash settlement. When that happens at scale, it puts pressure on the registered, deliverable inventories sitting in COMEX-approved vaults, and premiums for physical metal can spike relative to the paper spot price. We've already seen echoes of this in recent years, with unusual flows of metal moving from London's LBMA vaults into US-based COMEX warehouses, driven by arbitrage between the two markets, and by demand that increasingly looks less like normal trading and more like accumulation. Institutions, and yes, some governments, appear to be positioning for a world where physical possession matters more than a piece of paper promising future delivery. This is why some analysts distinguish so sharply between the paper price of gold you see quoted on financial news and the physical price you'd actually pay a dealer for a coin or bar in your hand. In calm markets, those two numbers stay close together. In moments of stress, they can diverge, sometimes sharply, and that divergence is itself a signal worth watching. Now, let's bring this back to something more personal, because macro theory is interesting, but it's not why you're really watching this. You're watching because you're trying to figure out what this means for your own savings, your own retirement, your own family's security. Here's the uncomfortable truth. Most people's retirement accounts are built almost entirely on paper assets denominated in dollars. Stocks, bonds, mutual funds, all of it ultimately a claim on future dollar cash flows. That's worked beautifully for decades because the dollar was stable and trusted. But if even a fraction of what we've just walked through plays out, continued central bank de-dollarization, continued erosion of confidence in the paper to physical ratio, continued historical pattern matching to 1971 and 2008 and 2011, then a portfolio with zero exposure to physical metal is a portfolio built entirely on the assumption that nothing changes. And if there's one thing history has taught us, it's that the monetary system does change, often quickly, and usually without much warning to ordinary people. This is where a lot of financially savvy retirees have started asking a very specific question. Is there a way to hold physical gold inside an existing retirement account without triggering early withdrawal penalties or a taxable event? And the answer is yes. It's a structure that's existed for years, commonly called a gold IRA, and it allows you to roll over funds from an existing 401k or traditional IRA into an account that can hold actual physical gold and silver, stored in an approved depository, all within the same tax-advantaged wrapper you already have. It's not some exotic loophole. It's a well-established provision that a growing number of people are using specifically because of everything we've just discussed: market instability, geopolitical tension, and a genuine documented shift away from total dollar dependence at the highest levels of the financial system. If that's relevant to your situation, again, there's more detail in that free guide linked below. Let's go back to the bigger picture for a moment, because I want you to sit with just how unusual this moment in history actually is. We are watching, in real time, a reserve currency system that has stood for the better part of a century show visible cracks. We are watching central banks, the most conservative, risk-averse institutions in the financial world, behave in a way that is anything but conservative by historical standards, dumping dollar-denominated assets in favor of a metal that pays no interest, generates no cash flow, and exists purely as a store of value. Institutions don't do that on a whim. They do it when their models tell them the alternative. Holding paper claims on someone else's promise is riskier than holding something with 5,000 years of monetary history behind it. And consider the psychology of scarcity for a moment, because this is where gold's story gets almost primal. Every ounce of gold ever mined in human history still exists somewhere. That's part of gold's unique character. It doesn't get consumed like oil or corroded away like most metals. But total global supply, above ground, is finite and grows only slowly each year as new mining output trickles in. When a growing number of sovereign buyers, alongside a growing number of individual savers who are waking up to this story, all try to claim a share of that same finite pool, the mathematics are unforgiving. Price is simply the mechanism the market uses to ration a scarce resource among people who all want it at once. And right now, we have more serious, well-capitalized buyers wanting gold than at almost any point in the modern era. So, where does this actually go from here? Nobody, and I mean nobody, can tell you the exact number gold will hit or the exact month it happens. Anyone who claims that kind of precision is selling you something. But what we can say with real confidence is that the underlying forces driving this move are structural, not cyclical. They're not the kind of forces that reverse in a quarter or two because a central bank cuts interest rates or a jobs report comes in better than expected. De-dollarization is a multi-year, possibly multi-decade process. Central bank accumulation has been sustained for years running, not a one-off spike. The paper to physical imbalance in the futures markets isn't something that gets fixed overnight. It's structural to how those exchanges have always operated. And the historical pattern of gold repricing sharply higher during moments of monetary confidence crisis has repeated itself with remarkable consistency every single time that crisis has occurred. Put those pieces together, and a path toward five figures for gold stops sounding like hype and starts sounding like the logical continuation of a story that's been building for years, one that most people are only now starting to notice. If you've made it this far, I want to leave you with something real, not just analysis for the sake of analysis. If you're someone who spent decades building a retirement account and you're watching central banks around the world quietly do exactly what we've described today, it's worth at least understanding your options. That's exactly why I put together that free guide I mentioned earlier. And here's something specific for those of you who've genuinely stuck around to the end of this video. If you mention this video when you request the guide, and you have $100,000 or more in any retirement account, you'll also get access to an exclusive, completely free, no obligation one-on-one web conference with an educational specialist who can walk through your specific situation. No pressure, no sales pitch, just information. And it's available specifically because you watched all the way through and took the time to understand what's actually happening in this market. Check the description below for that link. Whatever you decide to do with this information, don't ignore what the smartest, most conservative institutions on the planet are quietly telling you through their own actions. They're not buying gold because they think it's trendy. They're buying it because they've run the numbers, they've looked at the history, and they've concluded that the world's monetary architecture is shifting beneath our feet. The only question left is whether you position yourself ahead of that shift or find out about it after everyone else already has.